The government is playing favorites. In a single moment in January 2023, fees for nearly all new mortgages in the US changed, in some cases dramatically. This topic is a little mortgage nerdy, but it could be the key to paying or saving thousands of dollars on your next mortgage. I'll break down all the details you need to know, and stick around to the end. I'll share 3 loopholes, one of which can turn potential losers into big winners. If you can take a moment to click like and subscribe, I would appreciate it. It helps our channel grow and helps the algorithm put this important information in front of more people who can benefit. So, back in the early days of lending, when you applied for a mortgage, lenders would decide if you met their very most stringent lending criteria. If you did, awesome, you were approved. If not, your loan was denied. Not so awesome. Starting in the 90s, a new idea in lending took hold. This was called risk-based pricing. Under risk-based pricing, if you had, say, less than perfect credit or another reason that you'd normally be denied a loan, a lender could approve your loan and then just make up for the added risk they were taking on by charging you a premium, either a higher interest rate or maybe a little bit of extra closing cost. Risk-based lending is definitely a more nuanced approach to underwriting. Whether it's good or bad is debatable, and I'm very tempted to climb on a soapbox and go on a rambling aside about the positives that come from expanding access to credit versus legitimate concerns over fairness and the slippery slope that probably led to the subprime mortgage crisis. So I'm just gonna push that aside and say that these days, risk-based pricing is solidly embedded in mortgage lending. It's here to stay. Every rate sheet I get for every mortgage program includes a table of risk premiums, and mortgage insurance is actually the same. Fannie Mae and Freddie Mac got on this risk-based bandwagon in April of 2008, and they call their risk premiums loan level pricing adjustments, or LLPAs. And they're set by the FHFA, which is a little known agency that was set up to run Fannie Mae and Freddie Mac when the government took them over in 2008. LLPAs are a fee charged as a percent of your loan, but you'll never see a line item called LLPA on a lender's quote for your mortgage. These are actually fees that Fannie Mae charges to your lender. Your lender passes them through to you in the form of discount points or a higher interest rate. So it's important to you, but you're not going to see it on a lender's quote. The loan characteristics that trigger LLPAs are broad and include just about everything. The down payment percentage that you make if you put more or less down, your credit score, your occupancy, if you're going to live in a property as your primary residence, if it's a second home or a rental, and property type can matter too. If you're buying a manufactured home, a multi-unit property, or a condo, you can be subject to additional LLPAs. And helping clients understand and then minimize LLPAs is kind of one of my lending superpowers. I work really hard to get every client the best possible deal. So if we can save you 1% of your loan amount or lower your rate by improving your credit score for 1 point from, say, 679 to 680, or you could wind up with 5% more equity and better cash flow on a rental property with only 3.5% more cash up front, you'd want to know that, right? This is the type of guidance that I give to my clients every day, navigating LLPAs to secure the best possible loan terms. The LLPA schedule has been boring and stable for years. I think it's just about tattooed on some part of my brain, but that is all about to change thanks to the FHFA. We got a hint at what's on the FHFA's mind in January of 2022 when they announced significant increases to the fees on mortgages for second homes and for high balance loans. The fees on second homes went up massively by as much as 4.125%. That is $4,125 per $100,000 of loan amount. On a $400,000 loan, that's $16,000 of extra cost. These new higher fees were, to quote the acting director of the FHFA, targeted pricing changes to allow them to better achieve their mission of equitable and sustainable access to homeownership and to ensure access to credit for first-time homebuyers and low and moderate income borrowers. So this was more than just a change to fees. It signaled a vibe shift. Under the FHFA's current leadership, Fannie Mae and Freddie Mac are moving toward mission-based lending, and at least some LLPAs are moving away from risk-based pricing and toward what I can only think of as mission-based pricing. The FHFA wants to make homeownership more accessible to moderate income first-time home buyers, so they've decided to charge pretty much everybody else more. And in January of 2022, that was really just the start. In January 2023, the FHFA announced sweeping changes to LLPAs that affect basically every loan. And I'll rattle them off here just to give you an idea. For the first time ever, your debt to income ratio could make your loan more costly. If your total monthly payments are more than 40% of your income, you'll pay extra. They added 2 new bands for credit scores. It used to be if you had a 740 credit score or higher, you qualified for the best terms. Now 760 and even 780 are in play. They reduced fees for folks with lower credit scores, in some cases pretty dramatically. All loans with a 3% down payment saw a reduction in fees. And as an OG house hacker back in the day, bought a duplex and lived in it, I was super excited to see that loans for multifamily properties got a little cheaper. That's actually for both investors and for owner occupants. And with a big enough down payment, speaking of investors, investors putting 40% down or more on investment properties will see a little bit of a break on LLPAs too. But cashback refinances got significantly more expensive. And honestly, just for the vast majority of borrowers, if your credit score is above 680 and you're putting between 5 and 40% down, borrowing between 60 and 95% of the value of the property, LLPAs went up by as much as 0.75%. On a $400,000 loan amount, that's as much as $3,000 of added cost. If you want to see before and after on all the changes, I have links in the description below. They're big tables and you can compare anything that might be applicable to your circumstances. So I promised you a few loopholes. Let's talk about them. First, if you're watching this video prior to March of 2023, these changes haven't yet taken effect. If you're looking to refinance or you're in the market for a home, get your rate locked in as soon as possible. If you reach out to me, I can lock in a rate for up to 90 days before you're in contract on a property even, and extend a rate lock for another 30 days. If you're buying a new home, we can actually lock an interest rate for up to a year. Second, although the majority of loans come from Fannie Mae or Freddie Mac, there are lots of exceptions. FHA, VA, and USDA loans are not impacted by these changes. Jumbo loans, those that are bigger than Fannie Mae loan limits, are also unaffected. And there are a wide variety of alternative loan programs that don't follow Fannie Mae and Freddie Mac LLPAs. I've been using one of these loan options for most of my clients buying second homes in the last year, just due to those higher fees that Fannie Mae instituted last January. Third, and this is the biggest loophole of all, if you're a first-time home buyer and your qualifying income is at or below 100% of the median income for the area in which you're buying, or 120% of the area median income if you live in a designated high-cost area, you are a big winner. You are exempt from all LLPAs. You'll qualify as a first-time buyer if you've not owned a primary residence in the past 3 years. Income for purposes of the waiver is qualifying income for your loan. And this is really important to understand. That's the income that an underwriter signs off on when approving your loan, which may not be as black and white as you think. You can look up all of the median incomes for the areas in which you're looking, and the Fannie Mae has a tool on their website, which I've linked in the description below. But this is really, really critical. Make sure you have a knowledgeable and skilled lender in your corner. I'd be happy to nominate myself for the job. If not me, make sure you're confident you're working with someone who knows what they're doing. The way we document your income can affect the outcome in underwriting, and a skilled lender can work with you and, where possible, make the documentation and tell the story to kind of nudge the underwriter in the direction that we want so that you qualify for this fee waiver. Now, how much the waiver is going to save you will vary. If you have really great credit and you're putting 3% down on a single family home, you may only save a modest amount, but as my grandmother always used to like to say, it beats a poke in the eye with a sharp stick. She really did say that. That's the thing, right? But if you have so-so credit, if you're buying a manufactured home or a duplex or a condo, the savings could be like many thousands of dollars. And you can pocket these savings. You can just use them to reduce your fees and have less money due at closing, keep more money in your pocket, or you can apply them to buy yourself a lower interest rate and reduce your monthly payment. The choice is really going to be yours. And I wanted to throw in a bonus loophole that is not widely known, but if you've owned a home in the past 3 years, so you're not a first-time home buyer by the definition I mentioned before, but that ownership was with an ex-spouse, you may qualify as a born-again first-time home buyer and be able to obtain the waiver. If you found any value in this video, please like and subscribe and share it with anybody who could benefit from this information. Thanks for watching.